A good time to go to our next guest then. APL Apollo, that's the next corporate on our radar today. Motilal Oswal, well, they have maintained a buy rating on the stock, and the brokerage firm is optimistic about a couple of new opportunities for the company, both on the railway station redevelopment and the Jal Jeevan mission as well. To understand more about that, Mr. Deepak Goyal, the Director of Operation and Group Chief Financial Officer at the company, joins us on the show. Hi, Mr. Deepak. Good morning. Thanks so much for joining in. Tell us about both these two opportunities. The brokerage report coming out of Motilal Oswal believes that there is a good opportunity with regard to the Jal Jeevan mission, and it could lead to volumes of close to around 1 million tons approximately. There's also an opportunity in the redevelopment of railway stations. Wanted your inputs on this. What kind of opportunity can be thrown up from both these two?
Yeah, sir. In the Jal Jeevan mission side, we are getting very good orders from all the states because it's the center government mandate to all the states, and governments are working hard on this Jal Jeevan mission, sir. So currently, through our dealer and distributors, we are getting the good order books from these orders. And in the side of the railway, sir, is the Delhi railway station, Mumbai and Ahmedabad, where all the three big projects, we got our pipes are approved, and in the coming days we will get the good orders from them.
Okay, all right. You want to quantify it, Deepak? Jal Jeevan mission, it could translate to an opportunity of around 1 million tons, you think? For
yes, sir.
For the...
in the very short terms, it will be 1 million tons opportunity for the APL Apollo, because huge requirements around the country.
So your opportunity is 1 million tons. So you're confident that you will be able to, just trying to understand how competitive is this. So if, would you be able to garner, say, what percentage of the market share in terms of the bids?
Yeah, we have.
And who would your competitors be?
Competitors is there, the local competitor is there, but we have the facilities, the pan India. We have the 2 plants in the Raipur and 4 plants in the southern regions and 4 plants in the northern region and 1 in the west. So we are the single company which have catered the demands all over India. No one has the presence at a pan India basis. So our competitions with the local players, and no one have the appetite and no one have the capacity which we have so much. So we are quite confident that we will get the good orders from the Jal Jeevan missions, and it's obviously seen in the last couple of months also that we are getting the good orders from our dealer and distributor networks.
Okay, Deepak, hi, good morning. You've been growing volumes at 30%. Consistently. Even in FY24, I think your guidance calls for a 30% volume growth. This Jal Jeevan mission work, is this built into this volume growth guidance, or is this going to be on top of that?
It's also contribute in the growth pattern, but we are seeing good demand from the projects and construction sector also, because we launched over 500 by 500 scale box pipes, and we are going for the 1000 by 1000 scale pipe, 1 meter by 1 meter pipes. So it's a very good demand from the construction and infrastructure also, in the metros, in the railway, in the commercial construction building complex, affordable housings, everywhere we are seeing the good demand, sir. So we are expecting it will be a replacement of the civil or build-up steels in the near future.
So you're saying there's no slowdown in terms of demand, at least as of now, for structural steels?
Yeah, sir. Demand is very good. Very good. Yeah.
Great. My question to you, Mr. Deepak, is you are expecting to grow by around 30%. What is the industry likely to grow at? And if you're growing at such a clip, will it come at the cost of margins? Give us a sense about the EBITDA per ton that you're looking at.
No, sir. Our target is 30% growth with the double-digit margins also, sir. So in the last call also mentioned that in the 2 to 3 years our margins will be double digits, sir. So we are also expanding our margins by the product mix.
All right. So EBITDA per ton, what would it be? And VAP as a percentage of sales, what does it head to? I think at the last year it was around 56% VAP. Now you have the Raipur unit as well that will ramp up capacity. What is VAP contribution and EBITDA per ton guidance?
EBITDA per tons we are targeting each 5,000 plus in these years, and in the coming years we are targeting 6,000 rupees plus, sir.
Okay, and VAP, value added steel?
Value added steel, sir, within 2 years we are targeting 75%.
Okay, so your EBITDA per ton will increase by 11-12% from the current 4481 to more than 5,000, and your value added will go up from 56% to 75%, right?
75, yeah.
75. Okay. Can you talk about the export opportunity? How could that ramp up? Yeah.
We are in the process to install a new facility in the Dubai. From there, we cater the export market also, because India is a very good country. So we are domestically supply from the domestic plants, and for the international market, we will supply from the Dubai plant.
You want to put a number to that? Last year, I think it was a little less than a lakh, right? A little less than 100,000 or 60, 70,000 tons.
It's around 100,000 tons, sir. And this year we are targeting 150,000.
150,000 in terms of exports. Got it. Deepak, you're sourcing your raw material. HRC, I think, would be your sourcing, and you would be sourcing it from some of these large steel players. You're clearly dominant in the market today. But don't you think it could be a bit of a risk if one of these larger players, the Jindals of the world or the Tatas of the world, said, hey, APL Apollo is growing so well in this space, we also want a chunk of it. Do you see it as a risk?
No, sir. It's a different ball game, sir. They are in the flat steel producers. There is the volume game. So we are supplying in the 20 tons, 50 tons, 100 tons to the east customers. They are supplying in the thousands of tons, sir.
No,
so it's a different ball game. We have a very strong dealer and distributor networks. We have almost 2,000 SKU in the different thickness and different size. So it's
Deepak,
years. It cannot be replaced in a single year.
Got it. But the question is that will they get into the space, looking at the profitability, looking at the very strong growth? Apparently Tata's and JSWs actually are setting up capacity here. Tata's already have some capacity, and they want to increase that multifold over the next many years. So in light of that, you see no will there be more competitive intensity?
No, sir. Tata, in the last their presentation, they took a target of 3 million tons by FY2030. In the next 7 years, they increase their capacity to 3 million tons. We have presently the overcapacity is 3.5 million and going to be increased in the next year by 5 million tons. So market is also growing, sir. In this phase, market is also growing. It's a replacement of the build-up and civil structures also. So it will be a healthy competition. If they come into the business, it will be a healthy competition. It's a big market.
Okay, so you're confident that even if the bigger players are coming in there, by that time you'll be far bigger. And I think you have a plan that by 2030, your capacity will go to around 10 million tons?
Yes, yeah.
How will that happen?
By 2030?
It'll be all organically. How much of that 10 million ton target? Currently you're at around 3.6. You have a target of 5 million tons by 2025. And then you want to go to 10 million tons. So how much of this 10 million ton will come in organically, and how much of it will be inorganic?
All will be organic, sir. Though we are planning
You're sure?
Are you sure? Plant in the East India and Southern, all will be the organic, sir.
You're sure it's all going to be organic? Because your balance sheet is
100% organic, sir.
And your balance sheet is supporting you. You have only 200 crores of debt. By the end of this year, will you be debt free?
Yeah, sir. By this year, and we will be debt free, sir. With surplus cash.
Okay. Final question before we let you go. Ambit there pointed out that the promoter entity has made some investments in an NBFC, investment, and they are a little uncomfortable about that. They believe that could be a bit of a risk. What is your comment on that?
No, sir. It's a sporting over business. From the earlier, we are taking the channel finance from our regular bankers like SBI, Axis, HDFC, and other bankers. But they are not fulfilling the demands, and their reaches are not in all the regions. That's why we floated this NBFC, and it's doing very good works, and it's supporting the APL Apollo business also, sir. So it's a
Okay.
clean, it's a no risk at all, sir. It's supporting the APL Apollo business also.
They go on to say as well, they haven't seen any promoter successful in attempting the dealer, financing as well. But you're saying it'll support this business and you don't see it as a risk. Well, Mr. Deepak, thanks so much for joining. Do you want to give a closing comment?
Yeah, sir. This year we are targeting 3 million tons with a margins of more than 5,000 rupees tons, and next year we further given the guidelines for 4 million tons and 6,000 rupees EBITDA margins, sir. So we are working hard on these directions, and we will achieve the same.
All right, Deepak, great speaking with you. And that 100% no acquisition. I think I can say 99%. Leave 1% always. Who knows? Thank you very much for joining us, and we hope that we are able to speak with you more often on the channel. Thanks very much for taking out the time and joining us today. So that's APL Apollo with some perspective. We'll take a quick break here. Sunil Kaul of Goldman Sachs will be joining in to talk about their latest report. Again, we had, for example, Morgan Stanley yesterday talking about long-term growth prospects. Goldman Sachs report also talks about, zooms out, looks at the larger picture. So we'll talk about the report with Sunil in just a bit.